Welcome to this week's Market Update, where we review the key developments shaping markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets. This week, the story begins at home, with Canadian consumers showing impressive strength right across the economy. Canadian retail sales rose 1% in May to just under $74 billion, with every one of the 9 major retail categories posting gains. Early estimates point to a further increase in June, which tells us that households are still spending confidently on goods from groceries to vehicles, even with today's high interest rates. Healthy consumer demand supports corporate earnings across many industries, and it reinforces why we stay diversified across quality businesses. Next, there was a major move in infrastructure. Brookfield announced a $7 billion acquisition of APA Power, one of North America's largest battery storage developers. So why does this matter? AI, data centers, and electrification are pushing electricity demand steadily higher, and battery storage is essential to delivering that power reliability. It's a clear signal that leading investors are positioning for decades of growth in the energy transition and digital economy. And speaking of AI intelligence, the latest tech earnings showed those investments are starting to pay off. Alphabet delivered stronger than expected cloud revenue with growing adoption of its Gemini platform, and analysts see significant long-term opportunity in Meta's AI-enabled wearables. The key takeaway is that AI spending is turning into real revenue and stronger competitive positions, which supports our exposure to innovative companies with durable advantages and multiple pathways to growth. Now let's turn our attention to what drove our performance last week and why we remain confident in our current positioning. Exxon Mobil was one of our top performers, gaining just under 7% as oil prices climbed above $94 per barrel on expectations of tighter global supply. Attention now turns to Exxon's upcoming earnings report, where stronger prices should support robust cash flows and continued returns to shareholders. It's exactly why we own the company. Diversified assets and disciplined spending let it thrive in strong markets and stay resilient when conditions change. Naturally, the energy sector as a whole led our performance. ConocoPhillips rose just under 7%, Chevron gained over 6%, and holdings across the group moved higher with oil prices. These companies share a winning formula: strong balance sheets, disciplined spending, and significant free cash flow returned to shareholders. And it's not just a US story. Our Canadian holding, Enbridge, had gained more than 23% this year. Our value strategy was the strongest style contributor. AT&T jumped 7.5% after stronger than expected results, and industrial leader Honeywell also delivered solid gains. In uncertain markets, investors favor businesses generating consistent cash flow over paying premium prices for distant growth. That's exactly our approach: attractive valuations, sustainable cash flow, and disciplined capital allocation. Looking ahead, next week is a big one on the calendar. So here's what we're watching. The main event is next Wednesday's Federal Reserve rate decision, followed by Kevin Warsh's press conference. Markets will be listening for signals about the direction of interest rates through the rest of the year. Rate expectations influence everything from bond yields to stock valuations, so this is one of the most important items to watch. Next week is also important for earnings, with Microsoft and Meta reporting on Wednesday, followed by Apple and Amazon on Thursday. Investors will be watching whether these companies are turning their AI investments into revenue growth, just as Alphabet did this past week. Because they carry so much weight in major indexes, these results can move the entire market. And next Thursday morning brings the first estimate of US economic growth for the second quarter, after a solid 2.1% annualized pace to start the year. Continued growth would support the case for expanding corporate earnings. As always, we remain focused on helping you reach your long-term financial goals. Thank you for joining us, and we'll see you on the next update.